Major support for these broadcasts is provided by New York Community Bank, Chase Commercial Term Lending, Chelsea Lighting, Capital One Bank, Perfect Building Maintenance, Genova Burns, Giantomasi and Webster, Kilroy Architectural Windows, New York's Window Company, the Wyckoff Group, Greenberg Traurig, LLP, M&T Bank. Additional support is provided by Ackman Ziff Real Estate Group, Bank of America, Merrill Lynch, Briarwood Organization, Bruce Mosler, C.B. Richard Ellis, Colliers International New York, LLC, Cushman and Wakefield, Dime Savings Bank of Williamsburg, Douglaston Development, Levine Builders, DDG Partners, Friedman LLP, Accountants and Advisors, Flushing Bank, Investors Bank, James D. Kuhn Real Estate Center at Syracuse University, James Orphanides, Centurion Holdings, John Katsimatidis, Red Apple Group, Madison Realty Capital, Margolin Weiner and Evans, LLP, Certified Public Accountants and Business Advisors, Massey Knackle Realty Services, New Banks, Meridian Capital Group, Newmark Knight Frank, Sterling and Sterling, SJP Properties, Stonehenge Partners, and These Friends.
So it's called private equity. And the private equity funds and these people put out money to invest in different type of asset classes around the country and around the world. So today I've assembled 4 private equity executives to provide their insight on what they're doing, how they look at the market, and where they see the future. My guests today include Tim Yantz, who's a partner at Meadow Partners, Craig Solomon, who's the managing partner at Square Mile Capital, Kevin Davis, who's the Chief Investment Officer at Taconic Investment Partners. And last but definitely not least, Richard Mack, who's the head of North America for Area Property Partners. So how do you look at 2012 and 2013 for opportunities in the real estate arena, locally and around the country?
Well, Michael, I think the good and bad news is it's very competitive.
Yeah, but with 3 other people sitting here, I think these are part of your competitors.
Well, so if you were a big buyer from 2008 until now, it's probably a good time to sell. We've seen a lot of capital move into the markets, and we're trying to go places that are a little less crowded. So we probably can't buy any more office buildings in New York City, probably can't buy any more office buildings in San Francisco, but we're building multifamily again. We think that especially in the gateway markets like New York, San Francisco, Seattle, where we're building, even in Miami. And we see that there's an opportunity to produce product to sell into the core buying market, which is rapacious. And we also see opportunities to provide gap capital and preferred equity and mezzanine to people that are looking to recapitalize or are unable to borrow beyond 60%, so non-institutional borrowers. So it's competitive, but there are interesting niche opportunities, and that's what we're trying to exploit.
A lot of business over the a lot of people thought after the Lehman collapse and everything that there'd be an inordinate amount of distressed debt available. You bought a lot of the distressed debt. Today in 2012, are there opportunities for distressed debt?
Well, I think there's an inordinate amount of capital structures that are in distress, but they're being artificially buoyed by Washington's interest rate policy, which is keeping interest rates at historically low levels and allowing certainly floating rate borrowers to continue to be able to pay debt service. The real question will be what will happen over the next 5 years as all of this debt comes due. You know, there's roughly, I don't know, 1.7 trillion of commercial first mortgage loans in this country coming due over the next 5 years. Some significant portion of that cannot underwrite under current standards, and while those standards are loosening on a daily basis, I suspect that they won't get so ahead of themselves that they'll be able to underwrite a full recapitalization. So there's going to be a need for capital, gap capital as Richard put it, to sort of fill the void on some basis. In some senses, that argues for a cautious outlook in terms of valuation, as more expensive capital fills the gap that might otherwise be filled by traditional rates.
Now, Richard brought up a very interesting point. Prices, you know, we have changes with regard to the tax law one way or the other, depending on whatever the election is. You know, there's going to be capital gains changes. There are other situations, and prices have reached relatively high peaks since 2008. Do you think it's a propitious time for a private equity fund who's owned some property to try to get the highest price today? Kevin, Tim, Richard?
Depends the market that you're looking
talking
to sell
about the
into.
specific market, okay? You've had properties in New York. You've had properties in New York. You may have bought them in 2007, 2008. Is it a time to sell and let somebody take, as they say, take the chips off the table? Or do you keep it a little longer?
I think if you're IRR driven, yeah, you're going to make a great IRR on a transaction you bought, you know, 3-4 years ago. There might still be value to create in that asset, but if you want to be in and out and you know, you're an IRR driven investor,
listening to Richard's
it makes
comment
sense.
before that, you know, there aren't that many opportunities in this marketplace over here because prices may have reached plateaus that you really can't make. Do you think?
Well, I would say this. We invested about $800 million into the market during the downturn, 2009, 10, and some in 11. And for many of those transactions, it has been the right time for us to sell. We've done extraordinarily well, both on a risk
I remember when you were on my show and you hadn't bought something in a long time. You bought a shopping center, I think, in Texas.
We
right?
bought a
for like
$1.20
$25 a foot.
Correct. A 1 million square foot enclosed mall for $25 a foot from a special servicer. And we're in the middle of our value add program. We've leased a lot of the space. We're building the out parcels. We're stabilizing the tenancy. And we'll do very, very well with it. But the point I was going to make is, for us, many of the investments that we made are ready for sale. We'll probably end up distributing back to our investors this year $250 million. So that's a lot of realizations. And many of them have strong multiple, certainly on a risk-adjusted basis. So we do think it's the right time to sell some of those early investments.
Tim, what about you?
Well, look, we're investing and we're acquiring new property at the same pace as we're disposing of property. And so I think you really need to understand when you're talking about transactions, what you're talking about here. And, you know, as we were buying through 2009 and 2010, you know, you could buy good yield cheap. You could buy lower risk assets. And so now what we're doing is we're selling into the core markets. We're selling into this frothy environment. But the stuff that we're looking at acquiring right now and investing in is not the shiny pitch book, you know, competing with that cheap capital. I think everybody sitting here, you know, historically has tried to find creative ways to invest this money to outperform. And so I think there's a difference between what's happening on the core real estate side, the fully marketed pitch book, create an auction of 50 investors, and what we're all trying to do.
Let's look at some of the transactions that you've done and some of the that we have over here. You bought a note in Staten Island. You know, there's a question of, you know, and the market has done well. And then you bought a note also in Long Island City. Mm-hmm. Let's talk about that type of deal. What has happened to those assets?
Sure, and look, those weren't everybody's cup of tea, right? And they weren't something that could be.
As they would say, they had a little hair on them.
They had a little hair on them, which is what we all, you know, get paid to do is to underwrite, understand, and clean up the mess. And so those are deep value. Those are roll up your sleeves, really understand legal risks and your submarkets. But that's not conducive to this cheap, frothy money. It's not something that a core plus manager or separate account can get involved in. And so earlier in the cycle, that's where we saw a lot of the opportunities to generate these outsized returns, is to go to specific neighborhoods that maybe some others wouldn't, to buy distressed debt or defaulted construction loans for 20 cents on the dollar, or finish a partially complete building that somebody just couldn't underwrite construction risk. But the environment is changing, the deal flow is changing. But I think from a private equity side, all of us get paid to invest kind of upstream or against the grain of the core markets and these deep liquid markets. So yeah, I think the way that we would describe our business is buying off market, cleaning up assets, and then selling them into this cheap pool of capital.
Here's a very interesting point. When Richard entered the private equity business, you were an attorney at that time, you weren't in the business, it was a different world. How do you look at the RTC days as compared to today?
Well, the RTC days, I would love to have come back again. And I think
First of all, we were younger, so that
we were
was
younger,
better.
right? We were younger, and it was better.
Yeah.
Maybe it was only that we were younger, but I do think it was better as a buyer. We enter into this downturn with a lot of different things going on. Number one, the government was willing to let S&Ls fail, and S&Ls had a disproportionate amount of the bad loans, and they were willing to let them fail. They were making banks mark assets onto their books, and so once you mark an asset on your book,
you didn't have interest rates at these low levels.
that's correct. It made a lot of sense for people to liquidate. Now, we had a mass liquidation, and we had no standing pools of capital. It's hard to remember, but REITs were a fraction of what they are today. CMBS did not exist. And the standing pools of capital known as private equity did not really exist in the way we know it today. So you had a mass liquidation without a net. Today, we've had very little in terms of liquidation. At some count, 80 billion of distress is all that's traded. And yet we've raised, as an industry, 250 billion to capture that distress. And so it's probably not surprising that while there are probably many shoes to drop, the pricing on what has traded is nowhere near the returns that we were able to achieve during the RTC days. And the question is that healthy for the market or not? In many ways, I would argue it is unhealthy, because what we have done is kick the can down the road, and now we're waiting for this $1.7 trillion, and we have this uncertainty out there. And we've created this environment of great dichotomy where assets with hair on them can still be bought cheaply, but everything else that is kind of in a gateway market and is clean is trading at returns that we've actually haven't seen before, based on underwriting which is often as aggressive or more aggressive than what we saw in the go-go days. So it's created a very difficult market. I think it's not a market in equilibrium, but as a market that creates opportunities for those who know how to exploit it. But it is not the easy days of buying everything cheap, whether it had cash flow or was a problem asset, of the early 90s.
I mean, I think what Richard is spot on. And another reason that it's very, very different is that the downturn that we went through with the RTC was a fundamentals-driven downturn. We're talking about properties that were overbuilt markets, properties that were empty, see-through office buildings. That's where that phrase came from, was that downturn. So we had an opportunity to create value. We have a capital markets-driven downturn that we're going through now, and it's being managed externally through interest rate policy. It's just a very, very different kettle of fish. I think the one bright spot that one could consider is that, notwithstanding historically low cap rates, the historic spread between cap rates for most asset classes in most markets and treasuries is historically very wide, far wider than the historic average of about 150 basis points, which implies that there's room for treasuries to become less expensive, for rates to go up, while cap rates can stay low. That's what the hope is.
But let's be
Certainly one bet.
I mean,
I'm not making the bet, but
okay,
that's the theory.
I'm not a gambler.
That's the theory that Washington is measuring its policies by. That it won't cause a complete upheaval of the marketplace.
But here's the question: these rates can't stay there permanently, and if the rates go up and people are borrowing under floating rate, hey, it's great because your interest rate is so low. But if the floating rate, if you have to lock in. Not everybody is the amazing Kreskin that they can evaluate when to close on the deal. I mean, it's a difficult time. I mean, 2 years ago, no one would think that the rates would continue at these levels.
Yeah, look, it's very scary to think that you're buying at what are historically low cap rates, and that no matter what you do to cash flow, if cap rates move against you, you are going to lose money.
Yeah.
But on the other hand, I think what's driving a lot of this is what are your alternatives. And I'm not talking about fixing up and repositioning properties. I'm talking about core investments in buying cash flow or buying value add with cash flow. If you look at your alternatives, and I think this is what's driving it, it's to put your money in the bank at 1%, 2%, 3%. And so if you're able to generate 8 to 10% cash on cash, as some value add deals are doing, especially in non-gateway markets, and you can borrow with fixed rate debt, you're looking at getting 1.7, 70% of your money back over the hold of the property, and you can sustain a lot of cap rate expansion without loss of principal.
Now, you're fortunate that you and Craig can go anywhere in the country because of the way your funds are set up, that you're allowed to. Tim and Kevin are caught in. Kevin is limited to New York City. Mm-hmm. You're really limited to New York City, but you said to me before you can also do London and you can do Paris and DC. So you have a little bit more. If you're having your limitations over here, how difficult is it for you to find acquisitions?
It's very difficult. And we chase many, many deals, and we lose many deals. It's a very competitive market, probably the most competitive in the U.S. and one of the most competitive in the world, maybe outside of London. So it's very difficult, and you end up looking for opportunities that either others have missed, where you see value that others don't, or you just chase enough transactions that eventually things are missed by other people, and there's an opportunity that pops up.
So here's the question. We were talking before. Craig has invested in debt. And when in his investments in debt, he became a proud owner or an operator or a debt holder of many hotels. And one of his debts investment made you a owner of a very successful new hotel that's opened up over here called the Nomad, with some great restaurants. What asset classes, you have 4 investors over here. What assets do you really like around the country? I know Richard is... residential is the key. What about the other asset classes? How do we look at industrial? How do we look at the suburban office? How do we look at a variety of other hospitality?
Well,
especially to get the returns that you have as an obligation that you're trying to, when you spoke to your investors about returning this.
From the fund's perspective, we are relatively agnostic about product type, asset type. What we really are more focused on is where would we fit into the capital structure and how broken is the situation.
So you like it. The harder the broken situation, it's better for you.
That's right. That plays to our skill sets. While we understand, and I completely agree with the notion of, and I've done it, going to the Midwest and buying thousands of apartment units at 8.5 and 9 caps, adding some value, and borrowing at a 5 cap and getting most of your return on a current basis. By and large, that's not what we were hired by our investors to do. So if you're talking about what's broken, and there's still plenty that's broken, that points us towards, this is not on a fundamentals basis, it's just on an opportunistic basis, it points us towards hospitality, where borrowing power was still not as great as the other asset classes. It points us towards retail, which has got another leg down for sure, separate and apart from what's happening in New York City in urban retail. And to some degrees, it points us towards suburban office.
And I think what you're hearing is that it's tough to be bullish on many product types or sectors other than maybe residential right now from a fundamentals perspective.
Right.
But that being said, you know, in our business, and depending on your investment strategy, ours, for example, we made a conscious decision to dig deep in New York and London. Again, we're not trying to invest billions and billions of dollars of capital in a short time frame, so it makes our job a little bit easier. But outside of residential, you know, again, if you look at, you know, cities, whether it's San Francisco office or New York urban retail, you know, there are some pockets of macro opportunity. But then if you look at some of these larger cities, there's always going to be, you know, specific stories and micro opportunities, and that's, I think, where we see most of our deal flow, which is, you know, if nothing else, a function of the size of the city and the number of properties. You're always going to find something different, something quirky, some story.
You know, and you bring up a good point. I mean, one industry that has done relatively well over the last year or 2 years, and there's an opportunity in New York and in the suburban area, is the self-storage. Self-storage has been a very successful business in the REIT marketplace. It's been a strong marketplace. And as one person said to me, the reason that self-storage does well, because if you have divorces or other situations, that's one. And the other category is that people who had to move out of their homes to move into apartments, so they had to put their furniture somewhere else. So the self-storage might be as an opportunity. Have you evaluated that market?
Yeah, I mean, I think self-storage is very interesting. While we don't have billions and billions of dollars to invest, unfortunately, we have a little bit of a burden of more capital than less. And so, you know, we're really looking for larger deals, and self-storage tends to be smaller, tends to be niche-y, and doesn't really fit our mandate. So it's not something that we would do. I think it's an excellent entrepreneurial model. You know, it's not clear that in every market there's an exit out of self-storage, and you know, I think when things get tough, there are less people who are going to take you out of self-storage. But I do think it's an interesting market. I think, look, it's if you're in the opportunistic business today, it's about finding the deal, the niche. But if you're trying to combine that with putting out larger sums of capital, you have to look at the fundamentals. And so, you know, what we're trying to do is find deals where, in an economy where we're not forecasting growth, we can fix some problems, but also benefit from what I would say, a non-turn down in the fundamentals. And that becomes very, very hard to do. We focused on multifamily because we felt that across the country, investing a lot of money, there was fundamentals behind it. A big thing that we've also done is logistics, and logistics based on a change in the shopping patterns of people, driven primarily by the internet. And that's been going to those locations where we've seen the big e-commerce companies go, and following them from a logistics perspective. And we've bought about 12 million square feet of logistics over the last 3 years, and it's been a very nice business, and the fundamentals have been behind us. So we're trying to combine a kind of very niche-y perspective on deal by deal, what's broken, with where are the wins behind us, and hoping that will increase our performance.
What about the condominium market? I mean, you're selling condominiums in Staten Island. You have some condominiums, both of you together, I think, in Brooklyn, right?
We're in Tribeca.
No, but you also...
Oh yeah, we're partners.
Right, you're partners
right, yes.
on a deal. Do you have any condos today?
We have no condo exposure.
So what do you think of the condo market in cities like here?
Well, Tribeca and Brooklyn are two
Let's
very
take
very
Tribeca
different
first, and then we'll
markets,
talk about Brooklyn.
Right. Tribeca, it's great. I mean, the high-end residential market is as good as it's ever been, and seemingly getting better in New York City. I think you have it's primarily driven by foreign investors wanting to invest in hard assets in the U.S. and possibly remove their capital from their home base. And I think many of the high-profile properties you're seeing around the city are great examples of that.
Well, but you also own a high-profile condominium development.
We do now. We do
Yes.
now, and I think
That you took over because of the debt?
Well, we got into it as an opportunistic play and a niche type of an investment, but we felt that the fundamentals driving the condo market in New York were strong as well. I think what concerns me most about the condo market is that it can turn on and off very quickly. Because it's driven by externalities such as the flow of funds from offshore. But what makes me feel a little bit better about what's going on in the condo market in New York today is just that
Limited supply.
limited supply, financing is not available. We will ruin this market, of course, as we always do, and there'll be too much supply. But right now, we're not seeing enough financing, I think, to encourage oversupply.
Now, I think an interesting matter is like what you have in Staten Island and perhaps what the two of you have on the joint venture in Brooklyn. You have reasonably priced condos in Staten Island. That's somebody who wants to be a homeowner. How much does it cost them to buy a
$350,000.
So someone can have.
It's going to go up now with the Ferris wheel, though, right? You're gonna
Right, the Ferris wheel.
You have to raise your
and
prices.
The parking lot, right? Yeah.
Prices are going up.
Right.
I think what you've seen, especially in the outer boroughs, is a very, very sensitive price point. If you can get projects approved with agency financing, end user financing, units are moving. And if you have the flexibility and the basis to be able to meet the market, I think you're seeing very healthy absorption. We're seeing very healthy absorption. I think Manhattan specifically is a little bit different animal that's being absolutely driven by lack of new supply and demand.
The irony is the lower price units in Manhattan are having difficulties. The higher price units are easy to sell. That's what it is. Because families want larger units, and then the foreigners, as you brought up before, want larger units.
I mean, I think if you look at the demographic of that lower price point buyer, I think that's where, you know, when you look at the jobs that those people have, it's really, I think it comes down to down payments, right? If you're looking at the 25 to 40 demographic, you know, that's where the bonuses are, you know, have either gone away or they're all stock. You know, the ability for people to buy those units has been pushed off a few years.
It's the question of someone saying, you know, at this price, if I can get the end loan for the mortgage, because it's harder for those people to get that mortgage, is it worthwhile for me to go into to rent versus buy?
Well, the run-up in rents.
That's why rents are running up,
Exactly.
and especially in the markets that cater
Right.
to that demographic,
Exactly.
like Williamsburg, like Jersey City.
I mean, Williamsburg rents have reached $70 a foot. You know, these are rents. You know, how high can rents go?
I think the question of how high people's incomes can go, and I think that's
if you look at the buildings, it's a Manhattan demographic. It's the same exact income profile. If you look at some of the new buildings that have been built there, credit profiles, they qualify for any building in Manhattan.
It's relative affordability.
I know.
mean, you know, if you're a young person with a great job who wants a reasonable apartment, you're not going to get it.
And the city's much more diverse from an employment
Question.
base.
I wish we had more time, but we've got some good insight, and hopefully later in the season we'll have you all back. I'd like to thank Tim, Craig, Kevin, and Richard, and I'll see you next week.